Hi everyone, today we're doing capital gains. Capital gains is your fourth head of income. It is from section 45 of the Income Tax Act to 55. Now within 45 to 55 also, there are many sections, subsections that we have to study. So in front of you, for the ease of remembering everything and to ensure that you cover all the parts of capital gains, look through all these sections. So we will be doing all these sections. And only once you've covered all the sections, then you can ensure that you know capital gains. Now the first part of capital gain is section 45. 45 is the charging section. So for every income tax provision where there is income tax liability, you have to know which is the charging section. So for capital gains, it is section 45. What does 45 say? Any profits or gains from the transfer of a capital asset shall be chargeable to tax under capital gains. Now when you are reading this one line, the important words are profits. Any profit from transfer, profit from transfer of a capital asset. So you should know profits. We understand what is profit or gain. Transfer. What is the meaning of transfer under capital gains? We'll have to see that. And it should be a capital asset. So not all assets will be taxed under this. It has to be a capital asset. And when a capital asset is transferred, if there is a profit made during that transfer, it will be taxed under section 45. So what are the essential conditions? There must be a capital asset. The asset must be transferred. The transfer must have been effected in the previous year. So only when it is a transfer in the previous year can it be taxed in the assessment year. Profits or gains from the transfer of such assets which are affected in the previous year will be taxed under 45. Also, there are certain exemptions that are available under 54. And after the exemptions, if there is any profits left, then only it will be taxed. So, first thing is there should be an asset, capital asset. The capital asset should be transferred. During the transfer, there has to be some gain. And that gain, after taking all the exemptions, if there is any profit left, that profit will be taxed under 45. And when all of this should have happened in the previous year. Now, the first thing, what is capital asset? Capital asset is given under section 2(1) of the Income Tax Act. Capital asset means everything. What is capital asset? Everything. So, it includes movable, immovable, intangible, all of this. So, all types of assets, movable, immovable, intangible will be capital asset. It includes your ornaments of gold, silver, precious metals, any alloys, whether or not it is in precious, semi-precious stones, all of this is a capital asset. Okay. Now, what is not a capital asset? So, which does not include Mrs. SG. So, any asset which is a movable personal asset like your mobile phone, laptops, TV, even though it is very expensive, it will not be a capital asset. So, if it is a mobile phone or if it is a watch, so it could be a 1 lakh rupee watch, but because it is a personal movable asset, it will not be considered as a capital asset. However, if it is gold, a bar of gold, and you transfer that gold is considered as a capital asset. So it is not the value which is important, it is the nature of the asset. Next is rural agri land. Now you would ask, what is rural land? We will see. They have defined what is rural land. Okay, so the lands in the rural areas. Then stock in trade, because stock in trade will come under income from business profession. Special bearer bonds and gold deposit bonds. So there are gold deposit bonds also what the government issues. 6.5% gold bond, 7% gold bond. What is 6.5%? 7%. That is the return that you get on the gold bond. National Defense Gold Bonds, all issued by the government of India. Now, the transformation of physical gold into electronic gold. So, if I have physical gold and I convert it into certain form of electronic gold, or I have electronic gold and it is transferred into physical gold, and it has to be done by a SEBI registered vault manager, it shall not be considered as a transfer for the purpose of capital gain. So you could have gold, but you're converting the gold from one form to the other. It will not be considered as a capital gain. So everything else is capital asset. Now, precious stones, semi-precious stones, even if it is embedded in your apparel. So these days there are very expensive apparels, that is your wedding gowns, etc. Sometimes they have precious stones engraved into it. That case also it will be considered as a capital asset. But if it is any other apparel, so it could be a very expensive Christian Dior gown, but it will not be considered as a capital asset. But if it is a gown where there is diamonds or any kind of stones, precious stones which are engraved into it, it will become a capital asset. Okay, understood? Now, drawings, paintings, sculptures, work of art which are considered as antiques or any of those assets are capital assets. So if I buy a painting and that painting is then sold later on, so if I buy it for 10 lakhs and I sell it for 50 lakhs, that painting is considered as a capital asset. Okay, any antique pieces are considered as a capital asset. Got it? Now, if you see, the first thing is movable personal asset. The second one was rural agri land. Now, what is rural agri land? It is agricultural land where in a rural area. Now, what is rural area? Rural area is where the population is less than 10,000 and the area is away from the municipality limits. Also, and how much away? So, they are saying that if it is and if it is 2 kilometers from the local limits of municipality and the population is between 10,000 to 1 lakh. So if it is 2 kilometers away from the municipality, population should be between 10,000 to 1 lakh. 6 kilometers away from the municipality and the population is from 1 lakh to 10 lakhs. 8 kilometers away from the municipality, more than 10 lakhs. So if the population is more than 10 lakhs, it is 8 kilometers away from the municipality, then it is rural land. Okay, and if you transfer that rural land, it is not considered as a capital asset. Very important, because if in the questions they ask that any rural agricultural land is transferred, what is the capital gain on it? You will not do any calculation. You will simply write it is not a capital asset, hence not subject to capital gains. Now, what are the types of capital assets? The capital assets are of two types. One is short-term capital asset and long-term capital asset. How do you decide or know that it is a short-term capital asset? It depends on the holding. If the asset is held for not more than 36 months, the rule is 36 months from the date of the transfer. So, if I have transferred it on today, at least for 36, I should have held it less than 36 months. So, if I have held it less than 36 months, then in that case, it is a short-term capital asset. Now, there have been, so the rule is 36 months. However, for certain assets, it is only 12 months. So, if you hold the asset for less than 12 months or less. So, if I hold the asset for 12 months or less, then in that case, these particular assets, that is anything listed on the stock market. So, it could be listed equity shares, preference shares, securities, that is debentures, bonds that are listed, units of UTI, units of mutual fund, all of this should be held for less than 12 months. Then in that case, it will become a short-term capital asset. So, it should not be held more than 12 months. So, if it is 12 months, it will be a short-term capital asset. So, for listed securities, bonds, UTI, etc., it is 12 months. For unlisted shares and immovable property, this period is 24 months. So if you are holding the asset for 24 months or less, it is short-term capital asset. So 36 months is the general rule, 12 months is for listed securities and UTI, and 24 months is unlisted securities and immovable property. Now, what is a long? So this is if you are holding it for 36 months, 12 months or 24 months. Depending on the type of asset, it will become a short-term capital asset. What is a long-term capital asset? A long-term capital asset is what is not a short-term capital asset. So asset other than short-term are long-term. So basically, if it is held for 12 months or more, that is securities listed on a stock exchange, it is long-term if it is more than 12 months. So if it is 12 months, it is short-term. More than 12 months, it will be long-term. Listed securities, then units of UTI, zero coupon bonds. Okay, if it is more than 12 months, unlisted shares, land or building, immovable property. For everything else, it is 36 months. Unit of debt-oriented funds, unlisted securities other than shares, any other capital asset like gold, painting, precious stones, okay, archaeological excavations, everything. Now, what is transfer? So we saw what is capital asset. Now we are seeing what is transfer. Transfer is sari com, sale. A for acquisition, compulsory acquisition. R is relinquishment. Relinquishment is voluntarily giving up your right. Exchange. I exchange my one asset for the other. Very common when house is going to redevelopment. You exchange your old house for a new house. Extinguishment of rights. What is extinguishment? If I'm removing somebody, and when I'm removing that person, like when in a partnership firm, I have a right to the profits because I'm a partner. But my rights are extinguished. That is involuntarily I have been removed. And at the time of removal, I have got certain money. Because I am no more a partner, I have been separated from the partnership. As a separation, I have got money. That is called extinguishment. Conversion of any asset into stock in trade. Maturity or redemption of zero coupon bonds. Any other method where you are transferring or enabling enjoyment of immovable property or any other asset is called as a transfer. So, in the case of immovable property, transfer means conveyance of legal title. In case of immovable property, the title of the property passes to the transferee when the conveyance is executed and registered. In case of movable property, how is the title transferred? By a simple delivery. What is delivery? I give the goods to you. Like if I give you gold, the delivery is completed. There is no requirement of an agreement. But in case of a transfer of land or your property, you have to execute the document and take it to the registrar to register the document. That is called conveyance. For any other asset, you just simply transfer it. So in case of shares, I give you, endorse the share certificate, give it to you. Delivery is completed. So it is called a transfer. Okay. Next one. What are the types of capital gains? Depending on the type of asset. If it is a long-term capital asset, it will be a long-term capital gain. If it is a short-term capital asset, any profit on that transfer is called short-term capital gain. Now, when are the capital gains chargeable to tax and what are the exceptions? Capital gains are chargeable to tax when in the previous year. However, there are certain exceptions to this rule. What is the rule that we said? In the year of transfer, in the previous year, it will be taxed. Now see what is the exception to the rule. Now, first one is insurance receipts. As the name itself says that you have received money from your insurance company. So they are saying any profits or gains on receipt of money during the previous year from an insurer on account of damage or destruction of any capital asset as a result of any unnatural activity like flood, typhoon, accidental fire, etc. is chargeable to tax in the previous year when the asset is received. The money or the FMV of the asset on the date of the receipt shall be the full value of the consideration received or accruing. So what is the rule? The day when you receive the money, it will be taxed. The date when the asset or money was received. So if the asset was damaged, destroyed, say in 2020, but you received the money in 2022, it will be taxed in the year 2022. Okay. Now, the money or the FMV of the asset on the date of such receipt. So you will see on the date of the receipt what is the value of the asset, and you will compare that and you will see that is the full value of the consideration. Next one, conversion of capital asset into stock in trade. This is very important. Now understand what is the meaning of conversion of a capital asset into stock in trade. Now if I have gold jewelry we saw earlier is a capital asset, or any form of precious stones is a capital asset. Let's say for the sake of example, I have one entire big box of gold. Okay. Now, because if I have a big box of gold, if I transfer this gold, okay, that means if I sell it to you, I will have to pay capital gains tax. And you will take what? The fair market value. What is the value? Instead, what they are saying, that I say that, okay, I have a big box of gold. Instead of letting it be a capital asset, I am doing a business. So I convert my box of gold into my stock. So this asset is now my stock, because from a personal asset that I am now doing a business. And let's say for the sake of example, I had so much gold on 1/4/2020. I converted this gold into stock on this date 1/4/2020. I decided to do business of gold. Okay. So I converted it into my stock. So you will ask for how much you had purchased it. So I'll say I acquired it. Okay, this asset on 1/4/2015. So what it is? It is a long-term capital asset for me. For 5 years I held it, and then I transferred it and I made it my stock, my business. I started a business. Now understand what they are saying. The profits or gains from so when did I convert it? In 2020. Now I sold this gold because now it is my business income. I sold this gold on 1/4/2022. When did I sell it? After 2 years, because to sell it took time. So my question arises, okay, let's take numbers here. I had purchased this for 10 lakhs. I converted it into stock. And when I sold it for 20 lakhs. Now this 20 lakhs is actually not my capital gains. It is my business income, because now I'm a business person. It is my stock and I sold the stock. What they are saying over here, that when you convert it on that date, what was the fair market value? So I have to find out the fair market value on that date. When I converted it, the value was 15 lakhs. Did I get 15 lakhs? No. I had purchased it for 10 lakhs. In 2020, I converted it. On that day of conversion, the value was 15 lakhs. So they are saying that now you will have to pay capital gains tax on this value. Okay. And you will also have to pay income from business profession. Let's see this now. The profits or gains arising from conversion of the capital asset owned by the owner to stock in trade of the business carried on by him will be charged as his income in the previous year in which such stock in trade is sold. So when will it be taxed? When this is sold. So my capital gains is not going to be charged in the previous year. It will be taxed in the year when it is sold. And the FMV of the asset on the date of such conversion shall be deemed to be the full value of consideration. So what will be the value of consideration? It will be this value. It will be the fair market value on the date of conversion. And income arising from stock in trade, as I said. So there will be two business income. That is sale price minus FMV on the date of conversion. So what is the sale price? I said 20 lakhs. And what is the FMV? 15 lakhs. So that will be taxed. Capital gains will also be taxed over here. How? FMV on the date of conversion minus index cost of acquisition. We'll see what is index cost. Basically, you'll do 15 lakhs minus cost of acquisition. Okay. So you will have to pay two capital gains and income from business profession. When will it be taxed? In the year in which the stock in trade is sold. How we are going to do the calculation, that we'll see in the next part. Right now we are just seeing when is it going to be taxed? When the asset is sold, not when the asset is transferred. When does the transfer happen? In 2020. When is the asset taxed? In 2022, when it is sold. Okay. Now, transfer of beneficial interest in any security. Now, any profits or gains arising from the transfer of beneficial interest of securities by the depository or depository participant shall be chargeable to tax to the beneficial owner of the security in the year in which such transfer took place shall not be regarded as income of the depository. This is very simple. Basically, if you would have heard, shares are always kept in demat for listed securities. Okay, the demat has to be of one of the two depositories, CDSL or NSDL. What does CDSL do? Simple. CDSL simply keeps the shares in its own name. So in the books of the listed company, the registered owner is CDSL or NSDL. But in the books of NSDL, all the names of the shareholders are there. They are the ones who maintain a record. But who is the actual owner in the books? It is CDSL or NSDL. So they are saying that when does this transfer actually take place? When the beneficial owner transfers it, not when the registered. Who's the registered owner? CDSL or NSDL. So they are saying it has nothing to do with when the registered owner transfers. It is when the beneficial owner transfers it. So if I am holding shares through NSDL of Reliance, when I transfer the shares, that will be the date when the capital gains will be recorded. And it will be recorded to who? To me, because I am the beneficial owner. The cost of acquisition, also another important thing. So let's say if I have 100 shares of Reliance, I am selling only 25 and I bought it at various periods of time. So let's say I bought it on the 1st, I bought it in Jan for 100, assuming, for Feb for 150, then in March for 125, April I bought some shares for 110. Now, every time I bought 25 shares. Okay. So total how many shares I have? You say I have 100 shares. Now if I say that I am selling the shares for 130, can I say please take only 110 share, the price which is 100, which I purchased for 110? No, it doesn't work like that, because all the shares are now kept together. It's simply saying that it will be first in, first out. First in, first out is what? Which is the first in? This. And which is the first out? This only. So when I purchase the shares for 100 rupees, it is deemed that those are the ones which will be sold first. Okay, so that is how FIFO works. All securities are going to be following FIFO method only. Next one, introduction of capital asset as capital contribution. Now understand, when is this capital asset? Whenever you are doing starting a partnership firm or an association of persons or BOI, each individual or each partner will invest something. Then only we will start a partnership firm. So let's say we are starting a business and I get certain assets. What asset I'm getting? I'm getting immovable property. So that is my contribution to the business. Some person gets IPR. That IPR is contribution to the business. Some person gets gold. All of this is, all three partners get certain assets and they start a firm. Now, nobody actually purchases it. So what I do, I had purchased a flat for say 1 CR. I get it into the firm in 2020. Okay, I had purchased the asset for 2015. I got it into the firm. Now, they are saying whatever value, because in the books of the firm my contribution is recorded. So if the contribution is recorded as 1 CR, okay, that will be the money that I get into the firm. Similarly, the other people also will get assets. Now, so I have got it at the face value, same value, there will be no capital gains. But assuming I say no, the value that is recorded or should be recorded as my contribution is 2 CR. If I record it as 2 CR in the books of the firm is 2 CR, the 1 CR will be my long-term capital gains. Did I get any money? No. But because my contribution is now recorded as 2 CR, I will have to pay capital gains tax. So where a person transfers a capital asset to a firm in which he is already a partner or a member, or is to become a partner or member by way of capital contribution or otherwise, the profits or gains from such transfer will be chargeable to tax in the previous year in which the transfer took place. So when, let's say in 2020 the transfer took place, I have not received any money. In fact, I put my asset. I will still have to pay tax. For the purpose of this section, the value of the consideration will be the amount recorded in the books of asset of the firm. Okay, whatever it is. Now, similar case, but now we are dissolving the asset. Now, what we are doing? We are dissolving the asset. Today we are closing down the firm. The firm I had put in the books 2 CR is written. Now at the time of dissolution, the firm will give me the assets back, or if they don't give me assets, they'll give me certain value back. I get 3 CR back. Okay. The value that, or I get certain asset back. What asset? I get the flat back, the immovable property. The fair market value of that immovable property is to be taken into consideration. Fair market value of that asset is to be taken into consideration. The conversion from a, okay, so this is how it works. Now you have to pay a lot of attention for if there is a conversion of a partnership firm into an LLP, or a company into LLP, or a LLP into company. Those are also kind of conversions where all the assets of the company are now being converted into LLP. There is a conversion of asset. Instead of individuals, there is a firm which is now converting itself. From partners, you become shareholders. Now same thing, for the purpose of section 48, FMV of the asset on the date of the transfer shall be taken into consideration. Tax treatment of LLP, general partnership, is the same. The conversion from a partnership into an LLP will have no tax implications if the rights and obligations of the partners remain the same and there is no transfer of asset or liability after conversion. However, if there is a transfer of asset, then as per section 45, that is the charging section, you will have to pay tax. Now, compensation on compulsory acquisition. Now, what is compulsory acquisition? Understand. Now, the government acquires land from private parties like us, you and me, when it is building bridges, when it is building ports, when it is doing extension of roads. So if my house was near the highway, and because for extension of the highway, the government compulsory acquires my land, and it happens with compulsory acquisition, there is no negotiation that the government does. It just simply acquires it. That's why the word compulsory is there. When it acquires it, it gives you certain amount. Let's say it gives me, for my house that it acquired, it gave me 2 CR. However, the market, I had purchased it for 1 CR last year. What is the gain that I get? 1 CR. Let's say I purchased the land for 2 CR. The fair market value of the land today is 2.5. The government has given me only 2 CR. I acquired it for 2 CR, but the market value today is 2.5 CR. But the government has given me only 2 CR. Am I going to sit like that? No, I will go to the court. When I go to the court, it is very simple that the court will hear me and it will give me compensation. And sometimes they enhance the compensation that the government has given. So government has given you 2 CR, they will give me additional money, 50 lakhs. And that becomes my enhanced compensation. What is enhanced compensation? The extra that the court orders the government to give you. Okay. Now, what happens if your house is acquired in 2020? So the government doesn't give you money on the same day. It takes its own time. So the government might give you money in 1 year, 2 years. So when it gives you the money, it becomes taxable that time. Not when the house is transferred. What did the rule say? When the transfer happens, capital gain is to be paid. Now, in this case, compensation on compulsory acquisition, if the government has acquired your land and has paid you consideration, and the consideration is determined by the government or the Reserve Bank, when you receive the consideration, that time tax is to be paid. Also, when you go for enhanced compensation, you go to court, and the court then gives you the higher compensation. The difference amount, that is the amount that you have received, okay, from your first compensation, revised compensation, that amount will be taxed when the government pays you that extra compensation. When you get that extra compensation, no deduction is allowed. So that entire, let's say 50 lakhs is received, will be chargeable to tax. You can only deduct expenses that you have incurred for receiving this enhanced compensation. Like, for example, your court fees. Okay, your court expenses the government is allowing as deduction in enhanced compensation and nothing else. Okay. Now, what if it is an interim order? Interim order is temporarily the court says, yes, you are entitled, but it will take time. How much? So they'll give you an interim order. That is chargeable in the year in which the final order of the court or authority is made. So even if you have received certain money through interim order, it will be taxed when the final order, whatever the court decides as per the final order. Okay. Now, what you can subtract from enhanced compensation? The assessed capital gain of that year shall be recomputed taking into account the reduced amount. The recomputation shall be done by rectification. That is separate. Okay. Now, debt of the transfer. In case because it's a court case, it might take time. The enhanced compensation will be chargeable to tax in the hands of the person who receives it. So, if the person who was supposed to receive it dies, the person who receives it actually will have to pay the tax. Now, this is important. Specified agreement for development. Okay, now As the word says, it is a development agreement. It is an agreement with the builder or the developer. Generally what happens, let's say I have a piece of land and you are the builder, you have the expertise. I do not know how to construct. I do not have the money to construct, but I have a good piece of land. So we enter into a development agreement where the land is mine, construction is yours. Now, assessee is an individual or an HUF. So it's not between two companies. It is an individual or HUF and enters into a specified agreement for development of a project. The capital gain arising from such transfer of land or project shall be chargeable to income tax as income in the previous year in which the certificate of completion for the whole project is issued by the competent authority. So when is the capital gain will be chargeable? When a certificate of completion. So normally what happens when a construction is done? So you will see it happens in slabs. It doesn't, a building is not constructed overnight. So when the first plinth, then the second slab first, and it will so on grow. Now, when the completion certificate comes, okay, that is the construction is completed, the government authority certifies that is the time it will be chargeable to tax. Okay. Now, on what value that property will be chargeable to tax? The stamp duty value of the share in the land or building or both. So it could be if you have certain share in the land or the building, or if you have a share in both, of issuing of said completion certificate as increased by consideration received in cash. So it could be in any mode if you have received the consideration. Okay. So it will be stamp duty value right here plus any consideration will be the full value of consideration received accruing as a result of transfer. Okay, so stamp duty value plus the consideration received when on the date of issue of completion certificate. That will be the value of consideration. FPOC, whenever I write it is full value of consideration. Now, if it may however be noted that beneficial provisions are not applicable where the assessee transfers his share in the project on or before the date of completion certificate. So if you transfer the shares before the completion certificate, then you will not get this benefit. Stamp duty plus consideration. And capital asset would be deemed to be in which the transfer took place. The full value of consideration received shall be determined by the general provisions of the Act. What is general provisions of the Act? The fair market value you have to take and not the stamp duty value. Now, what is specified agreement? Means a joint development agreement, as I was saying, that or any other registered agreement in which the person owning the land or building agrees to allow another person to develop the real estate on such land and building in consideration of share, that is a land or building or both, whether with or without payment of the consideration or part of the consideration in cash. Now understand what happens. Again, I have a piece of land. Now there is a builder who comes and he says, okay, I will do construction on your land. So why will I allow it? I will only allow it if he agrees to give me a certain percentage in the land or the building or both. So he can say that, okay, 10 flats will be yours. I'll be very happy. Or if he says that, okay, the land will remain with you, the building will be mine, and I'll pay you lease every year. Something on those lines. Generally what happens, the builder gives certain flats, a share of the building, to the owner of the land. That is why it is called a joint development agreement. Now in that case, because I have given my land, I have got something in return, it is an exchange. What will be the capital gains for me? They are saying the capital gains will be the stamp duty value. When is the stamp duty value, the capital gains to be paid for that? It has to be paid on the completion of construction. Okay. So it could be that I get stamp duty value of whatever is my share. So let's say he gives me example, he gives me 10 flats, okay, plus he gives me 2 CR. So it could be consideration in cash or any other form of consideration. Give me some 10 flats plus 2 CR, 10 flats plus gold, 10 flats plus 2 CR plus gold. All of this will be the consideration that I have received. Okay, and I will determine the capital gains by comparing my full value of consideration. Okay, so I have received, let's say as per this example, I have got 12 crores. 2 crores he has given me, the value of each flat is 1 CR. So I got 12 crores. What is my cost of acquisition? I must have acquired that piece of land for say 5 CR. So 12 CR minus 5 CR, 7 CR is my capital gain. Got it? This is important. This can come for your exam. So basically stamp duty value on the certificate of assessee share. So whatever, as I said, 10 flats. Plus I get cash, I get any other check, whatever you call it. Okay? Understood? Let's go to the next one. Is capital gains applicable on distribution of assets at dissolution of a company? Very interesting, important. We do this on a regular basis. Companies get dissolved, and when it gets dissolved, there are assets which are distributed. Under section 46, we call it capital gains on liquidation. The company assets are being liquidated. Now, where the assets of a company are distributed to the shareholders on liquidation, such distribution will be regarded as a transfer by the company. Where the assets of a company are distributed to its shareholders. So, where will the assets go to the shareholders? This distribution is considered as a transfer. We saw that, okay, in the definition itself. Now, the shareholders receive money from the company on liquidation. This will be charged as capital gains as per the market value of the asset received on the date of distribution. So, on the date of distribution, if it has received money, it will be charged to capital gains. The accumulated profits of the company, if it is distributed, it is to be treated as dividend income. So, it will be as though it has received dividend and 10% TDS has to be deducted. Now, in the hands of the shareholder, it will be taxed as capital gain. So, if I am a shareholder, on distribution, I get 10 crores. Okay. I purchase, at the time of purchase of the shares, I put in 1 CR. 9 crores will be capital gains that will be taxed. Now, the company, what it has to do, because if there is any distribution of profits, it just has to subtract 10%, which will be TDS. There is no dividend distribution tax which used to be earlier. Dividend distribution tax is abolished. Simple. So whatever assets I get at the time of the dissolution, that will also be subject to capital gains tax. Now, let's see what is cost of acquisition of certain assets. What is the meaning of cost of acquisition? If there is, everything will have a value of purchase. Purchase value is called cost of acquisition. Okay, now goodwill, let's say goodwill if it is self-generated. What is the meaning of goodwill if it is self-generated? Every business, let's say if I am running a coaching class, it has certain goodwill attached to it. Because it is my goodwill and I have not paid anyone or I have not purchased it from anyone. It is self-generated goodwill. If I have not purchased it, it is not recorded in my books on the asset side. It is only recorded when I purchase it. This goodwill, if self-generated, the cost of acquisition is nil. Goodwill if acquired as in if I actually go and purchase it, the purchase prices will be the actual value of the acquisition. So if I purchase someone else's goodwill, like there are a lot of franchisees, if I have to run a franchise, I pay money for the goodwill. That money that I'm paying is my cost of acquisition. On gift, inheritance. So let's say if I've got I've got I've got certain gold jewelry from my mother. How much did I pay her? Nothing. It is inheritance or gift, okay, or on partition. But when I sell it, let's say the gold I have got is the market value is 2 lakhs, but I did not pay anything for it. Now, if I sell it for 2 lakhs, will I have to pay any tax? So let's say I got a gift from my mother. The gift value is 2 lakhs. I'm talking about gold because it is a capital asset. Now, when I sell it for 2 lakhs, do I have to pay any tax? You'll say no, because you're 2 lakhs worth of asset, you're selling it for 2 lakhs only. There is no profit. But I'll say I actually paid 0 rupees for this. My consideration is 0. So they are saying the cost of acquisition will, and I'll have to pay 2 lakhs because if the purchase price is 0, how do you find profit? Selling price minus cost price. Correct? Cost price is 0. So I'll have to pay profit or gain on this amount. Now this is not fair. So they are saying the cost to the previous owner. So if my mom had purchased it for 1.5 lakhs, 50,000 will be the cost of acquisition. To the previous owner, 50,000 will be the gain. Fair. Bonus shares allotted prior to 1st April. This will be the FN. What is the market value? You can't say bonus shares are free. It will be the fair market value on that day. Bonus shares that are allotted post 1st April 01, the answer is nil. The cost of acquisition is nil. Right shares, as you know, for right shares you might have to pay certain amount, the amount paid to acquire the shares. Right shares which are purchased by the person in whose favor a CSEET has renounced the right. So now in right shares there is an option that if I have got the right, I can give up the right to someone else, and that certain person has to pay the amount. So purchase price to the renouncer plus purchase price for acquiring the shares. So let's say I acquired the shares, you gave up your right. To give up your right, I give you 10 rupees. Plus to purchase the share, I pay 20 rupees. So what is my total cost? 10 plus 20. Stock in trade, that is converted into capital asset. We saw upstairs, it will be the fair market value. Now what we saw was capital asset converted into stock in trade. I'm talking about a situation where I'm a business person. I convert my stock in trade to capital asset. It is my personal asset now. So I have a gold shop. I say all the jewelry are mine. So whatever on the date of conversion, I will take it as fair market value, not what is written in the books. Okay. Now, are buyback of shares and other specified security taxed under capital gains? Very important question can come. Now, section 46A says consideration paid by a company on buyback of shares. So, if the company wants to buy my shares back, they have to pay me money. Is the value of consideration, is the full value of consideration, whatever money they pay me. Like recently, Paytm has done a buyback. For 600 rupees, they purchased the shares from the market. Now, the difference between the cost of acquisition and buyback price. So, I acquired Paytm shares for 200 rupees. How much did they buy back it for? 600 rupees. The 400 rupees is my capital gains. The difference between cost of acquisition and buyback price would be taxed as capital gains in the hands of the shareholder. In the case, so this is easy to understand. In the case of buyback of shares by domestic company, so it could be listed, unlisted, the company shall be liable to pay. So let's say we are talking about Paytm. So what did Paytm do? It acquired shares of its Chinese shareholders, okay, during buyback. In case of a buyback of shares by a domestic company, the company is liable to pay additional tax rate of 20% under 115QA. So this is under 115QA, they have to pay tax on the distributed income, that is buyback price as reduced by amount received by the company on such issue of such share. So let's say the company, I'm talking about PTM, has to pay. So the buyback price was 600 and at that they had received 200 rupees from the shareholder. The 400 rupees, okay, is on what they have to pay capital gain, they have to pay buyback tax under 115 QA. Consequently, so if they are paying that, the capital gains in the hands of the shareholder shall be exempt. So if they are going to pay, because it is paying under 115 QA, they don't have to pay tax under 1034A. Who? The shareholder. Shareholder will not have to pay tax. Okay. But if they are not paying tax under 115 QA, then it has to pay tax. Okay. So in case of a listed or unlisted company, so basically if it is a public company, then it will have to pay buyback tax and the hands of the shareholder it is exempt. In the case of a private company, the shareholder will have to pay the tax. There is no exemption under 1034. So any income arising to a shareholder on account of buyback shall be exempt in the hands of the shareholder. So because the company is paying buyback tax under 115 QA. So the shareholder will not have to pay tax. Simple. What is the mode of computation of LTCG and STCG? This is very important. Let's take one at a time. Let's see only short-term capital gains. You'll just take full value of consideration, or we call it sale consideration. Selling price minus expenses for transfer. So you will get net sale. Minus cost of acquisition. Selling price minus cost price, I told you. Okay. Minus cost of improvement. What is the meaning of cost of improvement? Let's say I bought a house and I did a construction. So I bought level 1 and I constructed level 2. That is cost of improvement. So that is also cost to me. Whatever it will be short-term capital gains. Got it? Now let's take another example. Long-term capital gains. What is long-term capital gains? You'll take full value of consideration. That is your selling price. Less the expenses, you'll get net consideration. Minus here, index cost of acquisition. Now I'll explain you what is index cost of acquisition. The house that you must have heard your parents, grandparents would have bought, would, let's say for example, because they've bought it so many years back, their cost of acquisition would have been, let's say 1 lakh, 2 lakhs, or sometimes you would have heard your grandparents say we bought it for few thousands. But when you sell it, the market value is not few thousands, it has gone to crores now. So if I would have just gone by this, I sell my flat which my great grandfather purchased for 1 lakh for 1.5 lakh. Can I say 50,000 is the gain? You'll laugh. You'll say, what is it there for 1 lakh? The value of the house is now 1 crore. The market value, because the prices have, because of inflation, prices have increased. But if you just take the simple maths, selling price minus cost price, this value is not going to be this value, you'll get a gain. Now, to take that practical situation into consideration, what they are doing, simple. They are saying that, okay, how much are you selling it for? 1 crore, so I'll say 100 lakhs. Now, my cost of acquisition, I agree, is 1 lakh. But I will have to index it. What is the meaning of indexation? To index it is to take inflation into account. So to index it, I will do is equal to cost of acquisition Okay, I'll do cost of acquisition into index year of sale upon index year of purchase. Now, what is the meaning of this SP? Now, so I have sold it in the year 22-23. Okay, there is a number that is associated with the year 22-23. We'll come to that. Index year of purchase. I purchased it, or my great grandfather purchased it in the 80s or 70s. Now that number will not be available. So you just have to take the fair market value as on 0, 1. Okay. And you will multiply this cost of acquisition into the number year, into the number year. Okay. So this value will increase. When I do this multiplication, my 1 lakh automatically becomes, after this calculation, 80 lakhs. So now I will subtract it and I will get 100 lakhs minus 80 lakhs. 20 lakhs will be taxed as capital, long-term capital gain. Similarly, I'll do for index cost of improvement. How will I do index cost of improvement? Simply take whatever improvement you have incurred. Okay, whatever improvement you have incurred. And this improvement, very important, you can take only if, okay, this improvement you can take only if improvement happens after 1/4/2001. If it is before 1/4/2001, you ignore it. If improvement before 1/4/2001, you will simply ignore it as if it never happened. If it is after 1/4/2001, you will just do index year of, instead of sale, it will become index year of improvement upon index year of purchase. Okay, done. You will take your index year of for the case of improvement. You will simply take index year of improvement upon index year of, you will take index year of sale. Sorry, the sale year will remain the same. This will not change. Instead of index year of purchase, it will be index year of improvement. First it was SP, now it will become SI. Simple. Okay. Now, what is cost of improvement? As I said, if you're taking goodwill or anything that you have self-created, cost of improvement is 0. But cost of improvement prior to 1st April, as I was just saying, will be nil. Cost of improvement shall be expenditure of capital nature, like if you're doing any construction, additions, alterations after 1/4/2001. Okay, cost inflation index in relation to previous year means index as the central government specifies in a chart. Okay. Now, let's see tax rates. All we have seen capital gains, improvement, everything. Now, let's see the tax rate. For short-term capital gains, it will always be as per normal rates. What do we know normal rates? If you are an individual, it will be as per your slab rates. If you are a company, it will be as per the tax rate you are paying, 25%, 30%, wherever, whichever slab you fall into. Partnership firm, it will be 30%, LLP 30%. So your STCG will be charged as whatever type of entity you are. But if you are a listed shares, okay, if you do intraday trading less than 12 months only, okay, if you have held the shares, it will be short-term capital asset and STT is paid. Short-term capital gain will be taxed at 15%. How much? Flat 15%. Even if STT is not paid, the STT is if it is listed. So you have to pay STT whenever you are doing listed security. Even if STT is not paid, the short-term capital gains arising from transactions in foreign currency on recognized stock exchange located in international financial center would be taxable at 15%. Now there are a lot of IFSCs. One of them is the Gift City that is there in Gandhinagar. That is called the International Financial Center. Now, deductions under 6A cannot be availed in respect of such short-term capital gains. So you cannot have any deductions. Basic exemption limit. So it is 2.5 lakhs, 3 lakhs, depending on if you are a senior citizen or not. Basic exemption limited can be deducted from short-term capital gains. For resident individuals, this is how the calculation will be done. What we said, the basic exemption limit deduction you will get. How much it will be taxed at? 50%. So let's say in intraday I made 10 lakh rupees trade. So you will say pay 1,50,000 as tax, 15%, correct? But what they will do first, you take 15% into, what is my long-term capital gains? 10 lakhs minus the basic exemption limit 2.5 lakhs. If I have got any other income, in my case I did not have any other income, it was only capital gains tax, capital gain income. So that will be 0. But if there was anything, you would add it there. The remaining amount will be taxed. And that amount will be your capital gains income. Capital gains tax. So 15% or 7.5 lakhs will be your tax that you have to pay to the government. Okay, for short-term capital gains. Now, if this amount, depending on what is the slab, 1 CR and 10 CR, you will also have to pay surcharge and you have to also pay 4% cess. There is no deduction available. Okay, however, for STG, other than those under chapter 6A, deductions are available. So basically 80C to 80U, no deduction is available. But if it is any other type of capital gains, not listed securities, it is flat 15%. But for any other, you can claim deductions under 6A. What is 6A? 80C wala chapter. Okay, the chapter of 80C, 80U, 80D, DD, etc. Okay, now let's come to long-term capital gains. Long-term capital gains is taxed at 20%. That is the basic rule. All long-term capital assets are taxed at 20%. For individuals, resident individuals, there is the same thing that we are doing, 20% into LTCG minus basic exemption limit minus other income. We just saw. Okay. Now, in case of unlisted securities or shares of a company not being a public company, tax on LTCG is LTCG at 10% without giving indexation benefit. In case of other capital assets, it will be LTCG at the rate of 20%. So, if it is unlisted securities of a company and not a public company, then it is how much? Because if it is a public company, then there is certain other exemption. If it is not a public company, you can take 10% tax only, not 20%, but you will not get indexation benefit. What is indexation? What we saw? Sale consideration minus index cost of acquisition. So you cannot do this. Okay. Deductions under 80C to 80U are not available. Now let's come to tax on listed securities. Earlier, LTCG on listed securities was exempt. So what people would do, they would keep it for 1 day more than 12 months and sell it off. In case of LTCG arising from transfer of listed securities, the tax payable will be lower of the following: 10% of gross capital gains without indexation and without giving benefit of basic exemption limit. Now, so in case of LTCG arising from transfer of listed securities shall be 10% of the capital gains. Okay, without indexation benefit or 20%. Now, basic exemption limit can be exhausted under this. However, we have to study this in comparison with 1128. Tax on long-term capital gains in case of securities that are listed on a recognized stock exchange or unit of equity-oriented fund or unit of business trust. Prior to 1/4/2018, any capital gains tax on sale of specific security was exempt under Section 1038. This exemption was withdrawn, and now this section has been added. So as per this new section 1128, if there is any listed security, it shall now be taxed at the rate of 10% on capital gains which are exceeding 1 lakh. The excess amount will be taxable. However, the benefits of not allowed from the tax payable on such the following. The benefit, there is no indexation benefit available. There is no Chapter 6A benefits, 80C, 80U and rebate. Okay, the cost of acquisition will be not at the price that you bought it at. The cost of acquisition will be this: fair market value of the shares as on 31st January 2018 or actual sales consideration accruing on its transfer. So it will be fair market value or the sales accruing on the date of the transfer. The fair market value of listed equity shares means the highest price quoted on the stock exchange. So what you will do, because earlier they were saying that all listed securities, if you are holding it for more than 12 months and then you sell it, there will be no capital gains tax. However, this was abolished. Because it was abolished, they gave some beneficial provision that okay, it will not be the cost of acquisition. So let's say if I purchase the share for 10 rupees by 2018. So let's take an example. I purchased it on 1/4/2010. That time the value of the share was rupees 100. Now this new law came. In February 2018 with the new Finance Act. It was very scary for everyone. But they gave a beneficial provision. They said, okay, you don't take this value. As on 31st January 2018, what is the value? So I'll say it has become 190. Now, let's take it today as on 1st March 2023. What is the value? The value has gone to 230. Okay, so instead of paying tax on 130 rupees, okay, this is my cost of acquisition. I will now have to pay tax on 40 rupees only. What they said, they got this beneficial provision that okay, you will pay, but you will not pay at your cost price. You will pay at the price of the shares as on 31st January 2018. What it was, 180. Okay. Now, how is cost of capital asset of the owner ascertained? How do you know what is the value of the cost? What is the value of the asset that the owner purchased it for or it acquired for? A person becomes the owner not only by purchase, because when I purchase, I can tell you what is the cost, but it could be a gift, it could be inheritance, etc. So we saw that when it is a gift, you will take the price of the previous owner. But there are many other ways also when you acquire the asset. So let's say in all of these cases, you have to add the cost and the improvement of the previous owner, and that will be your cost. So in case of inheritance, will, distribution of assets on liquidation, okay, any transfer of a revocable trust, under any transfer of capital asset, under any transfer in section 47(6) of a capital asset by amalgamation, on demerger. So in all these cases, you will see what was the value of the asset to the previous owner. Simple. Shares of amalgamated company received under the scheme of amalgamation. Cost of acquisition will be cost of asset acquisition of the shares in the amalgamating company. Now in all of these, I made it very simple so it is easy to understand. In case of shares during the process of conversion of bonds or debentures. So I have been holding bonds, now it is getting converted into equity. So it will be cost of debentures, cost of whatever I must have paid. So if I paid for debentures, it will be the cost of the debenture. I'm finding out the cost. Okay, specified security or sweat equity. So I have not purchased it, but I received sweat equity shares, or similar to an ESOP. It will be the fair market value that is taken into account for the valuation. Now when the mutual funds are consolidated, I was holding shares of one mutual fund. Now the mutual fund has been consolidated. It will be the cost of acquisition of the units in the consolidating scheme. So whatever I have paid for the acquisition. Equity shares received at the time of conversion of preference shares. It will be the cost of the preference shares. Whatever I paid for preference shares, now it has been converted. Okay, units acquired under the consolidated plan of mutual scheme. So it will be the cost of the unit in the plan. So whatever I purchased the units for. Shares received in the resulting company in the scheme of a demerger. So let's say I purchased shares of AB Limited. AB Limited has now been demerged into A and B. So what will be my cost of acquisition of A and what will be cost of acquisition of B? Because I purchased shares of AB. So they'll say the cost of acquisition of the original shares by the shareholder in the demerged company. So let's say I purchased it for 100 and this got 40% and this got demerged to 60% of the main company. Cost of acquisition of the original shares shall be deemed to have been reduced by the amount as so arrived under 49(2)(c). What does 49(2)(c)? The appropriate amount that has been demerged. So if it has been demerged, A has only 40%. So the value of your share will now be cost of acquisition will be 40 rupees and this will become 60 rupees. Got it? In a merger, it will be opposite. If A and B, I had shares of A and B and it has been merged to AB Limited. So what I'll do, my cost of acquisition of AB Limited will be the value of the shares that I have purchased A and B for. Capital asset being shares in the project in the form of land or building or both. The cost of asset by the completion certificate. Now as we saw, that is the development right, joint development agreement. So if I had land, now instead of the land I got 10 flats. What is the cost of acquisition? Shall be the amount that I have received as the share. So it could be 10 flats plus whatever consideration that I have received other than that. So that will be the full value of the consideration of that share for myself. Stock in trade before its conversion. We saw this. It will be the FMV of the inventory as on the date of the conversion. Now, how is capital asset computed in case of a depreciable asset? What is depreciable asset? Let's take example of a plant and machinery. Plant and machinery is a depreciable asset. Now, whenever we do accounts, if our company has 300 machines, let's say it is a company which does manufacturing of shirts, their plant and machine will be sewing machines, they'll have 300 machines. Now, they are not going to sit and do depreciation for each and every machine. They do it as a block, okay, and they'll write the value of the block. So, written down value, opening value, okay, let's say is 100. If there are any purchases, I will add. If there is any sale, I will subtract. I'll subtract the selling price and I'll add the cost price. So let's say in my case there was a purchase of 20 and there was a sale of there was a sale of 70. Okay, so what is my closing WDV? So simply you will say 120 minus 70. 120 minus 70 is how much? 50. So I had assets worth 100. I purchased 20 more. How much did I get? 120. And I subtracted 70. It will become 50. So that is my closing WDV. Now, how much depreciation I'll hit? For depreciation is at 15%. So I'll hit 15% depreciation on 50. Easy. So there is some assets in the block. What if? So this is one example. So what you'll do in this case? You have a positive amount. Okay. What amount you got here? 50. It is a positive amount. Okay. I'll hit depreciation. Okay. Now, let's take another example. This is simple, normally how we do. Okay, now pay attention for scenario 2. I have opening value of my block is 100 plus purchase less sale, correct? I did not purchase anything, or let's say, sorry, I purchased an asset worth 20 and I sold. So I have two assets in my block or 200 assets, but I sold one asset and I got exceptional amount. I sold it for 170. Can I sell it? Yes. I have assets in my block and I sold it for 170. Now, can I say my closing value is negative? Yes, it is negative. Because it is negative, can I hit a depreciation on it? You'll say no, depreciation is not allowed. Are there assets? Yes, there are assets. But this block, the depreciation cannot be hit because the value is negative, closing value. So you'll hit no depreciation. Can I say that there is actually a profit? Because I sold one asset at exceptional gain, 170. That gain is how much? 50. That 50 is short-term capital gains. Okay. Let's take another third scenario. I sell all the assets in the block. So I have 100. I don't do any purchases. But I sell all the assets in the block. So I sell it for 70. Okay. How much is left? 30 is left, closing. There are no assets in the block. I sold all the assets. All assets are sold. If all assets are sold, can I hit a depreciation? You say on what you will hit. If there is no asset, there is no depreciation. So what is this? If it's 100 and I sold all the assets for 70, can I say this is nothing but a loss? This is nothing but a loss. So this will be short-term capital loss. Now, let's take another scenario. Okay. I take all my assets and I'm selling all the assets. Opening value is 100. I have no purchases and I sell the assets for 120. Whatever I have, I sell it for 120. This 20 is nothing but my gain. This value is negative. This is nothing but my gain. It will be nothing but short-term capital gains. Is there any asset? All assets are sold. So there is no asset in block. So you can't hit depreciation. Okay. So in case of depreciable asset, you just have to see how are you affecting the depreciation. Obviously, if there is no asset in the block, you will either have short-term capital loss or short-term capital gain. If there is an asset in the block, but the value is negative, like see here, How will you hit a depreciation? Okay. Because it is appreciated. You bought an asset for 100, now you're selling it for 170. Your value is appreciated. How can you hit depreciation? So there will be no depreciation. There will be capital gains. Okay. Now, what is capital gains on slum sale? This also, what is slum sale? Slum sale is when the entire undertaking is sold without giving individual values to the assets or liabilities. Now, any gains from the slum sale which is held, any asset is held for more than 36 months. So it could be your undertaking is a new undertaking and you sell it, it will be short-term capital gains. But if even one asset is held for more than 36 months, the whole undertaking will be a long-term capital asset. What happens in this case? You don't give individual values and you find the net worth of the undertaking and then you sell it. Now they are saying that because there has been an amendment and they are saying that every time you find the net worth, this net worth has to be certified by an auditor and a filing is required to be done, the net worth calculation. And this net worth calculation has to be filed for your slum sale calculation. How do you do this? So what you will do, the lump sum price that you receive, that will be your consideration value, minus expenses, you will get your net consideration. Minus cost of undertaking. How do you find the cost of undertaking? Basically, it is your net worth. Whatever is the net worth, you subtract it, you will get your long-term or short-term capital gain. How do you find the net worth? Very simple. You will take net worth is calculated as written down value of the depreciable assets, add book value of all other assets. So for depreciable assets, you will take depreciated value. For all other assets which are not depreciable, like your land, you will take the book value. And you will subtract the book value of the liabilities. Whatever it is will be your net worth. To decide, as I said, the short term or long term period, you will just see whether even if one asset in your entire undertaking is held for 36 months or not. There is no indexation allowed in slum sale. Now, next one, Section 50C. What is Section 50C? That is capital gains on a real estate transaction. In case of transfer of a land or building, full value consideration is to be calculated as the declared consideration. Compare it with the value adopted by the stamp duty authorities, whichever is higher. Now, whenever you are transferring your flat, assuming land, building or any movable property, you will take the consideration value. But you will compare it with the stamp duty value. So, if I purchase a flat, I can purchase it for 1 rupee. But that is not how capital gains will be calculated. Because if my consideration is 1 rupee, you will have to take the stamp duty value, whichever is high. Let's say stamp duty value is 5 lakhs for that property. I purchase it for 8 lakhs. What will be the stamp duty calculated? What will be the capital gains calculated on 8 lakhs? Because that is the consideration I paid. You call it declared consideration. Now, Section 50C makes it a special provision for determining the full value of the consideration. It provides that where consideration declared to be received or accruing as a result of transfer of land or building is less than the value adopted by the government. That means that if you are saying it is less value, the value so adopted shall be the full value of consideration. That is the stamp duty value. And the capital gain shall be considered in that way only. However, now this is important. You will take stamp duty value. However, the stamp duty does not exceed 110% of consideration received or accruing as a result of the transfer. The consideration so received or accruing for the purpose of computing profits and gains shall be deemed to be full value of consideration. Now, what does it mean? They are using a 110% limit. So, let's say as per the stamp duty value, it is 100 lakhs. the consideration I paid as per the stamp duty value, it is 112 lakhs. The consideration I paid is 100 lakhs. How much more? You'll say 12% more. Correct? If it is 12% more, you will take what? Stamp duty value. Because it should be 10% or more. Let's take another example. Okay. It is as per the stamp duty value. It is 109. Consideration I paid 100. So what you will take? The difference is less than 10%. You will take the consideration value. Even though consideration value is lower than stamp duty. So they have put a 10% limit. Okay, to calculate capital gain. Now rationale for this of section 50B is fixed under the agreement. Section 50B has been amended in line with 43 CA. We'll see that to provide that where the date of agreement fixing the amount of consideration and date of registration. Also it could be that the date of agreement and date of registration are two separate days and the date of registration are not the same. The value adopted or assessable the value adopted or assessed by the stamp duty authority on the date of the agreement may be taken for the purpose of value of consideration of such transfer. So even though the dates are different and during that date, between the registration date and the date of the agreement, the value changes. You have to take the date of the agreement. It is further provided that these provisions shall apply only in case where the amount of consideration referred to has been received by way of account payee check. So it cannot be that you have paid it in cash. So it has to be that it was a genuine transaction. You paid the money through an account payee check or some electronic mode on or before the date of agreement. So on the date of agreement, you have received the money. And then subsequently you do the registration. Then you will have to take the date of the agreement only. Now, reference to valuation officer. Now, this is under section 50C, where it says that the assessee claims before an assessing officer that the value adopted or assessed by the authority for payment exceeds the stamp duty value, exceeds the fair market value. So now, for example, the value of the property actually is say 100 lakhs. But the stamp duty authorities in their records are showing it as 150 lakhs. In this case, I will obviously have to pay as per 150 lakhs as per this because 10% more. If it is there, the consideration more than 10%, the difference, then you take stamp duty value. Now, what if genuinely the stamp duty value is high or it is incorrect? Now they are saying the value so adopted or assessed or assessable such authority has not been disputed or no reference has been made before any authority, court, assessing officer, then in that case you can, so it is not a case that is pending in court and you can refer it to the valuation officer. There is a special kind of officer called valuation officer, and where the value then the valuation officer will ascertain that is it correct that the market value is only 100 but the stamp duty value is more. Then where the value ascertained by the valuation officer exceeds the value adopted. So let's say now the valuation officer comes. He has given a value of 151. Okay, or any other value which is more than the stamp duty value. The value adopted or assessed or assessable shall be taken as the consideration or accruing for the transfer. So you will take the stamp duty value only. Okay, but in the case the value is okay, but what if the value over here is 1 is 99. In that case, you will take what the valuation officer provides. Okay. So basically, it is valuation officer can decide it. Now, the other provision. So if you see, we have completed all the practical scenarios, all the theory parts of section of capital gains. We've completed all of this. Now we will only do the exemption sections. We will see, we'll do a quick recap in the next section, but just go through all of this. Do it from these notes only. And these are updated notes, so you need not worry. Everything is covered. Next section we are doing is section 50CA, capital gains on transfer of unlisted shares of a company. So let's say there are shares, the value of which is not derived from the stock exchange. Normally, if you have to purchase shares of say Reliance or Tata's or Infosys, all you will do is check the price on the stock market. And depending on what price you have purchased that share for. So for example, if I have purchased Reliance Securities, let's say my cost of acquisition for Reliance Securities was 100 rupees. I sold it. My net sale consideration was 150 rupees and I've held it for 13 months. You will say it is a long-term capital gain and you have got a capital gain of 50 rupees. Correct? Now, what if I tell you there is a company called XYZ Limited and the sale price is 150 and the cost of acquisition is 100. Now, the government is saying that we don't accept your sale consideration. You have to remove the FMV of the shares, fair market value of the shares, on the date of the transfer. And that if, let's say, the FMV of the share, what you have sold it for 150, the actual FMV for the share, fair market value, which a valuer derives or a CA derives, is let's say 200 rupees. They will not accept your 150. They will say the cost of acquisition, whatever you purchased it for, will be subtracted and your capital gains will be 100. Got it? So, most important, the FMV of such shares shall be the full value of consideration. The consideration will be the FMV of the shares. But let's say, for example, you sold it for 250 rupees. So, then they will take 250 as your sale consideration. This is the minimum. That is the base. You have to take your value as 200 or more than that. If you take for lesser than that, they won't accept. So if you have sold it for 250, they will say, okay, now you pay capital gains on 150. Okay. Now, special provisions for full value of consideration for transfer of shares other than quoted shares. So quoted shares are that which are quoted on the stock exchange, where the consideration received as a result of the transfer of a share of a company is less than the FMV. So let's say you have received, same example, my sale consideration is 150, the fair market value is 200. Okay. The values shall be deemed the value so determined, that is the fair market value will be deemed to be the value of the security. However, the provision shall not apply for any consideration result as a transfer to any class of person and subject to conditions as may be prescribed. So they have put a certain window that if we want to give certain exemptions to certain people, we can go ahead and do that. However, till date they haven't identified, but they can identify that if there are persons in the SEZ region or if they are in the financial region, like now the gift city is there. Gift city is in Gujarat. And if you are doing any transaction from there, then you may not be subject to capital gains. It may not be. So they are saying that we have kept a window. That's it. Quoted share. Quoted share means the shares that are quoted on any stock exchange. Okay, so whenever I say quoted means, so right now same thing what I told you, what you're going to do for unlisted, same thing you're going to apply for quoted, unquoted shares as well. Now, fair market value deemed to be the full value of consideration. That's what we said. Now, if for some certain shares it is not possible to determine what is the consideration that you have received, okay, or it is not ascertainable. So it could be that instead of shares, I got shares, but I did not pay cash consideration for it. I provided services. Could be. So what is my consideration? I gave services worth 100 hours. And in lieu of that, instead of cash, I got shares. Now they are saying what will be the value of these 100 hours? Not possible, not ascertainable. They are saying for all of this, we will only take the fair market value of the shares and we will say that is the consideration that you have paid for the shares. Okay. Now same thing, if I sell the shares and I have received some X amount of consideration, I sell it in the market or I sell it to some person, or I transfer shares and I receive something else in return. So it could be I receive certain assets, I receive some other form of security. In all of these cases, they are saying we are not going to detail as to what you have received. We are just going to take the FMV. So where it is not possible to determine the consideration, what we will take is the fair market value of those securities. Okay, simple. Now, this is another point, advance, which is forfeited under section 51. Now understand, I want to sell my house to you or I want to sell my shares to you. You give me an advance. Okay. Now this advance you have given me of 10 lakhs and you say within 7 days, I will pay you the remaining 50 lakhs. So the whole transaction is how much? Of 60 lakhs. Okay, that is the consideration, sale consideration. Now, what happened? After 7 days, you cancel the deal. So you do not pay the 50 lakhs. But in the agreement, we had decided that this is a non-refundable advance. Now, if it is non-refundable, I am not going to give it back to you. But you are saying that I cannot make provision for 50 lakhs and I cannot now pay you 50 lakhs. So I am not going to pay it back to you. So your money I will forfeit. Happens lot of times if you have joined certain membership and you pay only the first installment. Are they going to return it if you do not pay the second installment? No, it gets cancelled. Now understand what capital gains is saying over here. They are saying under section 51 that if you have got certain money, the forfeited money of someone else's that you have taken, either you pay this 10 lakh tax under section 56, that is income from other sources, saying that this is my income from other sources, or what you can do is you can deduct the amount. So let's say I do a subsequent sale. So tomorrow I find some other person, Mr. Y, and I sell it. Mr. Y pays me the money in one shot. He pays me 70 lakhs for my whole deal. So this is my sale consideration. Okay. I will subtract my cost of acquisition. What is my cost of acquisition? My cost of acquisition, for example, is 50 lakhs. Okay. They are saying from this, subtract the 10 lakhs that you have already got. So now you will have to pay tax on how much? 70 minus 50 is 20 minus 10. So you have got your cost of acquisition is 50 lakhs less the 10 lakhs. from here. So you will subtract how much? Only 40 lakhs. That means you will end up paying tax on 30 lakhs. Got it? Why this? So they are saying you have received for the same asset only. You have received 70 lakhs. You will say yes. So they are saying okay. So now from your cost of acquisition, whatever your cost of acquisition was there, you had purchased the asset for 50. You've already got 10 lakhs. You have forfeited. So now your cost of acquisition has become 40 lakhs. Got it? So either of the two, either you pay 10 lakhs or you subtract it from your cost of acquisition. So your cost of acquisition will become less and eventually you will pay more capital gains tax, or you can simply just pay on the entire 10 lakhs. You can show income from other sources. Okay, so that option is with you. Now, let's come to exemptions of capital gains. Under exemptions of capital gains, first remember, under section 1037, it exempts capital gains arising from an individual from transfer of agricultural land by way of compulsory acquisition. Also, agri-land is not considered, agri-rural land is not considered as a capital asset. Okay, so hence if you transfer it, there is no capital gains tax on it. Okay, next. Now the remaining that we are going to see is all over here. 54, 54B, B, 54EC, 54F, G, H, etc. Okay, so let's go. It's all in a tabular form. It won't be that difficult. Now, we'll try and do 2, 3 which are similar together. Now, let's see the first one. 54 and 54F. We'll do together. 54. What it is saying that you transfer your house property and you purchase another house property. So I'm writing here, you sell a residential house property and you purchase a residential house property. Who is going to do that? Residential, only individuals will say in residential house property. So residential and HUL. For how much period you have to hold this new house? You sell your old residential house property and you purchase a new residential house property. You have to hold it for at least 3 years. Okay. Now, in how much time you have to purchase it? So, I sell my house. They are saying in 1, 2, 3. 1, 2, 3. What is 1, 2, 3? Either you purchase it before selling. So, sometimes if I'm getting a good deal, I purchase the house and then I sell my existing house. Or you sell your house. Once you get the money, then you start looking for a house. That's normally what people do. So you have 2 years time for that. Okay, so this is before, 2 years after. Or if you're doing construction, this is 3 years construction. Okay, you have to purchase the house after 2 years or before 1 year or after 3 years if you are constructing. Okay. Now, the maximum deduction allowed. So, earlier there was no limit. So, if I sold a house for, I must have got it way back for like say 10 lakhs and today I sold it for 10 crores. Okay. So, I will make around 9 crore rupees of, I'll make 9 crore rupees of capital gains I'll have to pay. So, they are saying that okay, if you purchase another house of 9 crore rupees, you sell something and you purchase something within the time limit of 1 to 3, there is no capital gains tax because you sold something and you purchased something. But now with effect from 1st April 2023, there is the maximum deduction allowed will be capped at 10 crores and consequently the cost of the new asset will be limited to 10 crores. So for example, if my house is for 11 crores for the additional 1 crore, then I will have to pay capital gains tax. So let's say I sold my bungalow for 100 crores. I had purchased it for 10 crores. the 90 crores will be capital gains. Now, to save capital gains under 54, they are saying you purchase another house. So, I will purchase another house for 90 crores or more. They are saying, okay, so this full 90 crores is exempt from tax. Now, what has happened? They are saying, no, now you purchase a new house, but first pay tax on 80 crores. 10 crores exemption they are allowing. Okay, so this will affect the rich people. When they have bungalows worth 100 crores and 200 crores, it will affect them. Okay, the amount of gain or the cost of the new asset, because if I have got the gain, I put it for the purchase of the new asset. So how much exemption can they claim? Maximum of 10 crores. Okay, same to same, we are going to see, as I said, 54F. 54F, remember the word first. So if it is your first, as in you're a new purchaser, you have earlier purchased only one house. So now this is your second house at max. So you're a new purchaser. You can remember first. Okay. So what you do, you sell all your other assets and you purchase a house. That's normally what people do. They break their FDs, they sell their shares. Okay. So you sell anything and you purchase. You sell anything and you purchase a residential house property. Who purchases a residential house property? Always individual and HUF. Okay. So what is the period of holding? At least 3 years. You have to hold it for at least 3 years. Okay. Now, how much time you have to purchase the new house? Same to same. 1 year before, 2 years after, or 3 years if you are doing a construction. Again, under section 54, this is capped now at 10 crores. It has been capped at 10 crores. So earlier, if you would sell any asset, so I sold shares and I purchased a residential house property, but it was not subject to any tax. So now I sell shares worth 50 crores. Okay. And I want to purchase my residential house. They are saying, no, first you'll get an exemption of 10 CR. And the remaining 40 CR you can purchase a house. But on 40 CR you have to pay capital gains tax. So if I sell 50 CR, I get 50 CR. I go and purchase a house of 60 CR. I put 10 crore of my own. They are saying, okay, but on this, your capital gains tax will be how much? 40 crores. Okay. What is the difference between 54 and 54F? Simple. Here it says under 54F, you can purchase residential house by selling any asset. Now there are certain conditions. Let's go here. It should not own more than one residential house other than the new asset on the date of original asset. So I can have one, and this should be max my second house. Okay. So this should be my new house, should be my second house at max. It could be my first house or second house. So my full sale consideration should be invested to get the capital gains tax, but otherwise you'll get proportionate basis. We'll see what is this net sale consideration. We'll see how much exemption you can claim. This is important to remember. You will get out of the money that I have got, I do not invest everything. I sold my house for 100 crores. I must have purchased this for 20. So you will say I've got 80 crores capital gains tax. They are saying fine. But that exemption also will tell you how to calculate. So you will have to calculate the net consideration. Okay, and only that much amount you can claim as exemption under 54. So we will see how to calculate. But for now, what you'll remember, there is a limit of 10 CR. Okay, now let's go to 54EC. EC, you have to remember bonds. Okay, you have to remember bonds. EC. And there is one more. Okay. 54EC, and there was a new section added, 54EE. Both are similar, so I'm writing it here. 54EC and 54EE. All the provisions are same except for one small thing which I'll tell you. Okay, so what you'll do, you sell any asset, house, you sell your shares, you sell anything, and you purchase shares. Which share? You purchase bonds. Okay, which bonds? Bonds that are government has recognized those bonds, and those bonds are RECL and NHAI. So I'm writing what is the name of those bonds? RECL and NHAI bonds. You have to invest in those bonds. But how much can I invest? First thing, you have to invest in how much time? Within 6 months of sale, within 6 months of your transfer of your asset. And once you invest that amount in RECL or NHAI, how much exemption can you claim? They are saying, listen, you put in 10 crore rupees, no problem. But the maximum limit will give you 50 lakhs only. How much? 50 lakhs only. And it has to be held for at least 5 years in that bond. So you cannot invest, take the benefit and then break the bonds. You have to keep it for at least 3 years. Same thing they have said in section 54EE. Instead of NHAI and RECL, they are saying, okay, RECL and NHAI, they are saying you put in startup bonds. Startup fund or startup bonds. How much they will give you? They will give you same 50 lakhs exemption, but you have to keep it for at least 3 years. Okay, same thing. How much exemption you will get? Up to 50 lakhs. Now, next one, let's come to 54B. 54B, land used for agricultural purpose. So what you have to do? You have to sell your land for agricultural purpose and you have to purchase agricultural land within 2 years from now. You will say that, ma'am, if agricultural land is exempt. Now, this is urban agri land. You sell your urban agri land if you have, and you purchase agricultural land within 2 years from. So if you sell agricultural land, they are giving you exemption. Okay. How much? The capital gains amount, whatever it is, you can claim an exemption for it. And you should at least have used the land for at least 2 years. So there has to be a holding of at least, you should have held the asset for at least 2 years. And once you purchase the new agri land, you cannot sell it for at least 3 years. Okay, so this is, B is, remember, Bombay. Bombay is one of the biggest urban lands. So you remember, if you sell a agricultural land in Bombay and you purchase anywhere in India, agricultural land, you will get an exemption under 54B. What is it subject to? You have to, you should have kept the land for at least 2 years. And once you purchase a new land, keep it for at least 3 years. Okay. How much exemption you will get? The entire capital gains, whatever you have received, you can claim an exemption. Let's come to 54D. 54D, land and building or any right therein used by industrial undertaking compulsorily acquired under any law. Now, for D, you always remember any kind of drama of force. Okay. So, if the government has acquired compulsorily your industrial land, okay, they have acquired compulsorily your industrial undertaking. So, land or building or any right in any industrial undertaking, then you can claim an exemption under 54D. Now, for how much period you should hold that new land? So, what you have to purchase is if government has acquired it, then you purchase somewhere else. Okay, and government does that. So, you can purchase any other land, building, etc. In how much time? At least they have given you a period of 3 years. You can because to transfer your land is not going to, industrial undertaking is not going to be easy. So they are giving you a period of 3 years. Once you transfer it to another place, your industrial undertaking, keep it at least for 3 years. So your lock-in period of holding, or I'm going to write here lock-in, is how much? 3 years. Okay. And how much exemption you can claim? You can claim capital gains. The entire amount you can claim as exemption. Okay. Now the next one. 54G. Same thing what we did in 54D, but here it is land building or any right therein plant and machinery in urban area used for the business. So they are saying that shifted. G for any gaon. Gaon means village. So go to the village. G for go. Go to the village. So if you have any land building or plant machinery in urban area and you shift it to an area other than urban area. So what is other than urban area? Rural area. Okay. Doesn't matter for how many years you have held it. Acquires assets in how much time? Within 1 year before or 3 years after. Okay, 1 year before or 3 years after. What exemption you will get? The whole aggregate of capital gains you can claim as an exemption. Okay, this is what go away from urban land. So they are saying all industries go away from urban land and start your business elsewhere, and we will give you an exemption. Next one, 54GA. You transfer your land or building or any right. So this is similar. Here what they are saying? Go to village. Here they are saying go to special village. Go to SEZ. Okay, so you take your land, building, plant, machinery in urban area used for business and you go in SEZ area. Okay. And once you go there, you at least in how much time you have to go? So once you sell it or 3 years after sale, because it will take time for you to go as well. So 3 years after sale. And how much exemption you will get? The whole capital gains tax you can claim as an exemption. So we are done with all. Just let's recap. Okay, 54 and 54F we studied together. What is that? You sell one residential house, purchase another residential house. 54F, you sell anything and purchase a residential house. The only thing is there is a limit of 10 crores. Okay. 54B, they are saying if you sell land used for agricultural purposes in urban area and you purchase agricultural land within 2 years from date of transfer. So in that case, you can claim a benefit. Now same thing, 54G and GA. Go to village. They are saying sell your land, building, plant, machinery. This was agri land, what they were talking about in 54B. G is go to village. From where? From urban areas, they are saying go to villages or SEZ area. Okay. Then we saw 54D. 54D is compulsory acquisition. D, remember, is any kind of force, drama, okay, where they are acquiring it compulsorily, your industrial undertaking. You can claim an exemption under 54D. And they are saying you whatever you incur, okay, you will give you 3 years time to shift and the entire amount of capital gains is exempt. Next one, 54EC and EE are same. EC is what you sell anything and you purchase bonds. Which bonds? NHAI and RECL bonds. Okay, NHAI and RECL bonds. Now, 54EE says if you buy bonds and you have to keep the bonds for at least 3 years. Then 54F. F we already did. So, it's done. Now, let's go to capital gains on transfer of 54GB, the last one. Who can claim? GB is get doing business. GB is get doing business. How to do business? They are saying if you are an individual or HUF and you can sell anything, sell your house. Okay, they are saying sell your house and from the house what you have to purchase? Sell your residential house property and you purchase shares. Okay, shares of company. And in that company, which company? Where you are, so you sell shares, you get money. That money you put over here. Okay, you sell your house and you get money. That money you put in a company. That company may you at least have to hold 50% stake. Once you have 50% stake, the company receives money, company has to purchase asset. Not 50, you have to hold at least 25% stake, and that company has to put that money that it has received in purchase of machinery, assets. Okay. And which kind of company? A company which utilizes it for the purchase of new asset. Okay. If it will be taken away, exemption will be taken back at the amount of exemption given earlier it shall be, okay, sorry. For how much time you have to put that money in the company? For at least 5 years. Okay, and it has to be used for purchase of plant and machinery. Got it? Now, okay, what if if you do not want to invest in any of the other assets? So I sell one of my assets, I sell my gold, but I do not want to buy bonds, I do not want to buy residential house property. So they are saying you can put investing amount in capital gains fund account. There is something called as a capital gains fund account, and you will get the same benefit. What happens in this central government capital gains fund? Your amount is locked for a period of 3 years. You will keep getting minimal interest, but you don't have to pay any capital gains tax on it. Okay, now this is the last part and your chapter is done. There is a new section that has been added. Is it 55AA? Market linked debentures. What is market linked debentures? These are debentures where there is no fixed interest rate and the returns are determined on the underlying index. So like you have Nifty is one index, okay, then you have Bank Nifty as another index. So there are different indexes. The underlying could be equity benchmark, government yield, gold index, anything. So it could be a underlying index will determine your yield. Okay, the advantages that you're getting, good exposure and upside in the market, such as equity, government securities, without taking the risk of directly investing into it. Because if you directly invest, there is a possibility it will become zero. Here it is dead. So you'll at least get your principal back. So your upside can be anything, but your principal is fixed because you're putting money in a loan. Market linked debentures are generally issued for a tenure that is ranging from 13 months to 60 months and has high investment value. So it cannot be for few, like if I want to buy shares, I can put even 5,000. Normally market linked debentures have a higher investment value. It can be listed, unlisted, secured, unsecured. They are liquid instruments which are bought back by the issuers at times. So sometimes they will purchase it back and give you the principal amount. Now, earlier, so there is the taxability has been issued. Any capital gains from transfer, redemption or maturity of these kind of debentures will be short-term capital asset only, irrespective of the holding period, and will be taxed at your slab rate. So if you have a higher income group, you will be taxed at a higher slab rate. Earlier, prior to this, okay, it was always that if you're holding it for 12 months or more, it is long-term capital asset and it will be taxed at 10%. If an unlisted, LTCG shall be taxed at 20% with indexation benefit, without indexation for non-residents, and the period of holding shall be 36 months. And if it is less than 36 months, it was treated as a short-term capital asset. But now it is all clear that it will for all purposes be treated as a short-term capital asset only. Okay, now let's go and try the sums of capital gains. What you see in front of you is the indexation chart. Now, I'll just explain you in like 30 seconds what does this chart mean. In 2000, it is basically taking into account the inflation. In 2001, it starts with 2001. The index, let's say, was 100 rupees. Now, in 22-23, that same 100 rupees ka value, the value of 100 rupees has become 331. So, basically, your asset values will have to be increased to that extent. Okay, if the value of something was 100, now the value has become 331. So, you don't have to by heart this chart. This will be given in each and every exam. You don't have to ever by heart this chart. Let's see how we are going to use it in our sums. Ravi purchased land in Jaipur for 12,18,000 on 15th October 2000. He constructed the first floor on 15th December 2016 for 1,08,000. On 15th December 2022, he sold the house for 52 lakhs. The expenses on transfer was 29,000. Compute the capital gains. The first thing that you will do is you take the sale consideration. Okay, always. How much was it? 52 lakhs. Was there any expenses incurred or he got the entire full 52 lakhs? You will say no, there was expenses on transfer. So you will subtract the expenses. And the remaining will be okay, that will be net sale consideration. Now, this is your net sale consideration. You will subtract your cost of acquisition. What is the acquisition cost? He purchased the land for 12,80,000. But didn't we just see that if you have purchased the land or anything, actually this date we need to change. We will put it 2001. Okay, if it is not given, you will have to take it as FMV. Now, he purchased the land in 2001 for 12,18,000. Can I say that this is a long-term capital asset? Obviously, because he purchased it in 2001 and he's selling it in 2022. So, I'll have to do indexation. Okay. Now, how do I do indexation? You'll have to remember this. Cost of acquisition into index year of sale. Which is his year of sale? 22-23, because it is 15th December 22. So, what is the financial year? 15th December 22. What is the financial year? 22-23. Okay. Upon index year of purchase. What is the year of purchase? He purchased it in 2001-2002. So, how will we do this? What is the cost of acquisition? 12,18,000 into index year of sale. What is the index? 22-23? 331. What is the index year of purchase? 2001-2002. That will be 100. Okay. So, what will this amount come up to be? Use your calculators. 12,18,000 into 331. I'm getting. Okay. Now, did he do any other expenses? Let's see. He constructed the first floor. So, there is cost of improvement. But that also he has done, so you will get indexation benefit here, index year of sale upon index year of improvement. When was the improvement done? In the year 1617, see, the 15 December 2016. So, what is 1617? 264. So, you do 1,80,000 into 331 upon 260. Okay. 1,80,000 into 331 divided by 260. So you get 22,568. Okay. Let's see 51 lakhs, 71,000 minus 40 lakhs, 31,580 minus 22,568. Okay, my answer is coming to your long-term capital gains will come up to 91,378. Okay, this is what your answer is going to be. What did you do? First you took index cost of acquisition, then you took index cost of improvement. Simple. Subtract both and you get your answer. Now, next one. Sachin purchases a house in Jaipur for, again, for 18,20,000 on 31st December 1990. He paid registration fees of 1,82,000. On 15th August, he sold his house. The expenses on transfer was so and so. Now, here you will have to write the fair market value as on 1/4/2001 of house is 19 lakhs. Now, let's take same thing. How much did he sell it for? Sale consideration 64. Okay. So the sale consideration is 64,50,000. The expenses you will subtract 64,050. So your total answer is 63,85,500. Okay, that is your net sale consideration. Now you have to do index cost of acquisition. For index cost of acquisition into index year of sale upon index year of purchase. What is the year of sale? August 2022. So can I say 22, 23? What is the year of purchase? Now he purchased it in 1990. See, when did he purchase it? In 1990. If he has purchased it in 1990, you can't do anything. You can't go because the index table starts only from 2001, 2002. So they will have to give you the FMV of the house, which they have given you. Is how much? 19 lakhs. So you will take 0102. Okay. So your cost of acquisition, you will take 19 lakhs into index year of sale upon index year of purchase. Okay. So your answer, long-term capital gains for this will be 96,500 only. Got it? Okay. Now, let's do the next one. Shri Yuvraj purchases a house in Chinchpokli for this. He paid registration fees. The FMV of the property is given to you. So what you will take? FMV you will take. Okay. Yuvraj purchases a house for this much on 20th December 1990. He paid registration fees so much. What at the time of purchase? The FMV of the property. So the FMV is given to you is 7,25,000. He constructed a floor, okay, for 3,80,000. On 15 December, he sold the house for 82 lakhs. The expenses on transfer was 82,000. So please can you tell me what will be your net consideration? Now this you can tell me easily what will be the net consideration. Net consideration will be 82 lakhs minus 82,000. So you will get, I'm just writing your net okay. Step 1. I'm writing what will be the net sale consideration. What will be the net sale consideration? Sale consideration minus expenses. Okay. So what will be your sale consideration? ₹82 lakhs minus 82,000. You will get 81. Okay. Now you do index cost of acquisition, easy cost of acquisition into index year of sale upon index year of purchase. What is index year of sale? 22, 23 and purchase is 01. Cost of acquisition is how much? 6.5 lakhs. What is the index year of sale? 331 for 2022-23. Index year of purchase. Now, this is interesting. What they have said that he purchased the house when? Okay, he purchased and the FMV is 1.4. FMV is 7,25,000. Now, Remember this. Asset before 1/4/2001. What will you take? FMV as on 1401, or we take fair market value as on, or the cost of acquisition, whichever is higher. Now, what is the FMV as on 1/4? So you will say the 7,25,000. Okay. What is the cost of acquisition? 6.5 lakhs. No, it will be 6.5 lakhs plus the 65,000 that they have incurred. See here. Plus 65,000 he paid for registration. So it is not how you will subtract net sale consideration. You will add to get your actual purchase cost. So you will add the 65,000. How much do you get? 7 lakh. In that case, this is higher, so you will take 7 lakh 25. But if this was higher, if this was 6 lakh 45, you would have taken this as 6 lakh. You just take that amount. Okay. So, what will be your cost of acquisition? 7 lakh 25,000 upon 100. This is what I am getting. Is there any cost of improvement? He constructed a floor on 10 February 2000. Now, remember this. If improvement before 1/4/2001, you will ignore it. Okay, you will ignore it because you cannot find the FMV of improvement. So they are simply saying ignore it. Okay. But if this was done after 1/4/2001, the improvement you would have taken it, like what we did in the earlier sums. What is your answer? Long term capital gains, you will get 57, 80. Okay. Got it? Let's go to the next one. Natasha sells her personal residence on 1/7/22 for 45 lakhs, which was acquired by her on 1/4/2000 for 2 lakhs. She carried on improvement twice on 1/3/2001 for 50,000 and on 15/3/2003 for 5 lakhs. The FMV of the house was 1/4/2001 on 4 lakh. The brokerage was 2% of selling price. Okay. So now, first tell me what will be her net sale consideration. 45 lakhs minus 2%. So, we'll get 44,100. Okay. Less you will subtract index cost of acquisition. We'll take cost of acquisition. Okay, let's do it here. I'm just putting net sale consideration. How much is it? 44 lakh 10,000 less index cost of acquisition. What is your cost of acquisition? Index year of sale upon index year of purchase. Simple cost of acquisition 4 lakh 50. because the amount that they have given is prior to 1/4/2001, so we can't take it. Index year of sale, when did she sell it? Okay. I'm getting total. Okay. Then we do index cost of improvement. Let's see when she improved it. Improvement was twice. 1/4/1/3/2001. What did I write? Ignore before 1/4/2001. So this I will ignore. Okay. And on 15/3/2002. This I will take. So what you will do? 5 lakhs into sale. Improvement, when did she do? In the year 15/3/2003. That is which financial year? 1/4/2002 to 31st March 2002. Correct? So it is year 202 to 202. 105. Hundred 105. Into 331 divided by 1576,190. Whatever you get is your long term capital gains. So we'll do 44,110 minus 1489,500 minus 1576,190. Okay. Now next one. Mushir bought 5,000 shares of rupees 10 each on 1st May 1993 of JT Limited. The company issued bonus shares on 1/12/1990 and he received 1,000 bonus shares. So he's got bonus. On 1st April 2001, the FMV of the shares were 15 rupees per share. He sold the shares on 15 December 2016 at 125 per share. The brokerage was 1% selling price. So let's do this together. And we'll say consideration minus expense will give you net sale consideration. So can I write first original share and these are bonus shares. Why am I writing this? Because for bonus shares, the cost of acquisition will be 0. Okay, let's see now. He bought 5,000 shares and the FMV of the shares is 15 rupees. He sold the shares in 2016 at 125. So how many shares are there? There is 5,000 shares and he's got bonus. Okay, and he sold the shares for how much? 50. At 125 per share. Okay, he sold it at 125. So they are saying that he sold it at 125 rupees per share. What is the expenses on transfer? 1% of selling price. What is the cost of acquisition? See here, over there he has purchased it. She purchased 5,000 shares at 10 each. But the FMB they have given is 15 rupees. So you will take 15 rupees. FMB on 1,420 is 15. When did he get the bonus? He received 1,000 bonus in 1990. Okay. Now see. Cost of acquisition when in 1990 prior was 0. So what will you take? 15. Okay. But what if these shares were purchased, the bonus he received after 2020, after 2001, you will have taken cost of acquisition as 0 only. The only reason you are taking cost of acquisition as 15 now for bonus shares. For bonus shares, you are taking 15 because this applies if you've received the purchased the asset before 1/4/2001. So here you will take index cost of acquisition. You can do it for both same. Cost of acquisition is 5,000 into 15 into index year of sale. What is your year of sale? 2016, 2017. 264. 264 upon 100. Always when you have two different assets, please solve it separately. It will always be helpful. Okay, over here it will be how much? 1,000 into 15 per share into 264 upon 100. What will be the answer? Total capital gains. Okay, to add both of them, you get long-term capital. Got it? Done. Come on, let's go to the next one. Sufyan purchases a house in Chiplun for 85,000 on 15 December 1880. Before 1/4/2001, what will you do? You will simply see the fair market. Okay, the FMV of the property as on 1/4/2001 is 1,05,000. The house was acquired by BMC on 15/10/2008 for 18,76,500. The first installment of 5 lakhs was received on 15/4 and the balance on in 2017. Calculate capital. Simple first step you'll do sale consideration. How much did they give you? So if you do instead of sale consideration, full value of consideration, because here you have not sold it, you can say that it was acquired compulsorily. So what is FUC? Full value of consideration. 18 lakhs 76,500. Okay, less index cost of acquisition. Cost of acquisition is how much? We'll take FMB, so 1,05,000 into index year of, there is no sale, so here you will take index year of transfer. The first installment, so Sufyan purchased the FMB of the property. The house was acquired in 2008. So here you will take transfer, right? When was it acquired or transferred? So you will say 8, 9. Okay, and index year of 4. So then what was it in 8, 9? 157 upon so you subtract 1,43,850. Divided by 100. So you get 1,43,000. And the installment of 5 lakhs. So you subtract minus 1,876. Long-term capital gains. Okay, now when is this long-term capital gains required to be paid? As soon as you receive the first installment, so you will pay the full amount as capital gains. First installment you received in 15/4/2016. Either you pay the full amount of capital gains here, okay, or you pay in the ratio that you have received. So if you have received only 5 lakhs, that is how much? Around 1/3 of the amount. So you can pay that much, and the balance you can pay. But the government will not let you pay when you receive the full amount. So you will have to pay either 5 lakhs as capital gains in 2016, and remaining you can pay the remaining when you get the remaining amount. Okay, so how much is the tax? It will be at the rate of 20%. Okay, so how much is the tax? It will come to 3460. So that will be the tax. How much tax you have to pay? Long-term capital gains tax will be this. When do you have to pay it? As soon as you receive the first installment. It will become applicable when you receive the amount. Okay. Now you have to pay it in that quarter as advance tax. You have to pay it. Otherwise, what you can do is, so when you receive the second installment, you don't have to pay any tax. Let's do the next sum. Shri Azhar purchases a house in Delhi for 3 lakhs in May 1996. Now, if he has purchased the house in May 1996, it should strike you that the FMV of that house has to be taken as on 1/4/2001. So, what is the FMV? It is 3,50,000. The house was acquired by BMC in June 2006 for 4 lakhs. So in 2006 he got certain money. Can I say in 2006-7 he has received some money of 4 lakhs? Now, Azhar claimed additional compensation in court and was awarded 8 lakhs in Jan 23. However, the payment was made in April 23-24. So when did he receive the amount? 23-24. Because it is April 2023. Expense in relation to the court fees is 20,000 and court proceedings is 60,000. Now compute the capital gains. He received the amount in two parts, so we will also have to find capital gains in both the years. Now the first year, what is the sale consideration? There is no sale consideration, but can I say full value of consideration? You will say yes. How much is that? Full value he's received 4 lakhs. Less index cost of acquisition, because obviously it is purchased, we'll take FMV as on 2001. So you will say cost of acquisition into index year of sale upon index year of purchase. So there is no sale but acquisition, compulsory acquisition. Same thing. Okay, when was the index cost of acquisition? You will say 3.5 lakhs. 3.5 lakhs into index year of sale. What is the year of sale or acquisition? 2006-7. Check your table. How much will that come to? Upon purchase 2001-2. So this I know is 100. Check your table. How much will that be? That should come to 122. Multiply, find the answer. You should get 4,27,000. How much will that be? You will get a loss, long-term capital loss of 27,000. Now, this loss, either he can set it off if he has any other capital gain that year, or he can carry forward. Now, in the year 2023, what happens? He receives certain other money, additional compensation, correct? How much is that additional compensation? 8 lakhs. Now from that 8 lakhs, you cannot do index cost of acquisition again and subtract. All you can do is subtract the expenses. How much is the total expense incurred? 20 and then 60 for the court proceedings. So total 80,000 will be subtracted because he incurred 80,000 expenses. So the remaining 7,20,000 will be long-term capital gains when in the year 23-24. If this has not been set off, obviously he can set it off with the long-term capital gain if there is a loss which is carried forward. Okay. Sufyan and Azhar formed a partnership firm just after the formation. So when you form a partnership firm, you have to bring assets into the firm. So both of them got assets into the firm. One got house property and one got ornaments. When was this formed? In 15 July 22. So your financial year is 22-23. Okay, the market value is given to you and you amount recorded in the books of the firm, 9 lakhs and 36,000. However, they purchase it for 60,000 and 15 lakhs. You will take for your full value of consideration. You will always take, okay, what you will take? Full value of consideration. You will always take the amount recorded in the books, book value. So here it is 9 lakhs and here it is 36,000. Okay, less index cost of acquisition. What is index cost of acquisition? You will take cost of acquisition into index year of sale upon index year of purchase. Now, in this case, what is your cost of acquisition? Here it is 60,000 into index year of sale 331 upon index year of purchase 56. So let's see what is 56. 56 is 117. Okay. Same thing here, you will take 15,000 into index year of sale or we say transfer. That will be what? to 331 upon 1011. What is it in 1011? 167. $60,000 into 331 divided by 117. How much will that be? 1,69,740. Okay, I subtract, I'll get the value over here. What will be the value here? 15,000 into 331 divided by 167. Okay, your value will be 29,730. Okay. Now find out what will be your answer. 9 lakhs minus 1,69,740, 743. Okay, so how much am I getting? I'm getting here capital gains of 7,30,257. Here what I'll get? 36,000 minus 29,730. Okay. This will be my capital gains. Got it? Now next one. Pooja, a jeweler, had personal jewelry. Now see what is this Pooja doing. Pooja takes out personal jewelry. That is a capital asset. And she converts it into stock in trade. And then she sells this stock in trade. So, she has capital asset. That capital asset, okay, she converts it into stock in trade. So can I say there will be capital gains over there? And then she converts it and then she sells it. When she sells the stock in trade, that is income from business profession. Okay. Now, she converted the jewelry into stock in trade on 1/4/2005. The FMV of the jewelry on 1/4/2005 was 8 lakhs. So you will take FMV always over here. Okay. And then she sells it for 12 lakhs. But the value that is recorded in the books is 4 lakhs. Okay. And the actual cost was 2,59,000. So over here, this transaction is going to be subject to capital gains tax when she converts her capital asset into stock in trade. Now, so first let us find out the capital gains tax on it. Very easy. What is her full value of consideration? You will take the fair market value. Okay, less index cost of acquisition. So what is the index cost of acquisition? You will take 2,59,000 into the index here of conversion, that is conversion to stock in trade. So she converted in 2005. So can I say 5/6? Okay. And when did she purchase it? She purchased it in 1995. So for that case, I will have to put FMV on 1/4/2001 is how much? 2,59,000. They have to give you. Okay. Now, so this will be 100 and this will be 5/6. Let's go and check what is it. 117. Okay. Into 117, 2,59,000 divided by 100 into 117. So what will be your answer? 4,96,970. That will be your capital gains tax. When is this capital gains tax to be paid? This is to be paid when your actual assets are sold. When the assets are sold, she sold the jewelry for 12 lakhs. When did she sell the jewelry? It could be any time. It could be in 2022, whatever. You will pay the tax, this capital gains, whatever is the applicable tax, into 20%. That you will pay when the asset is actually sold. But this is how you do the calculation. Okay. Now next one. Before we do the next one, I have to teach you two important concepts. Under section 54F and 54B, you do not get exemption of the entire LTCG. You will get proportionate exemption. What is the meaning of proportionate exemption? This is the value of your asset, net sale consideration, means your old asset which you sold, and that is the gain that you get. They are saying whatever you purchase of your new asset, the appropriate proportionate gain you can claim as exemption. So what does it mean? Net consideration or exemption claim will be new asset value into LTCG upon net sale consideration, that is old asset value. Now based on this, let's read this. Okay. What did he do? Mushir transfers a plot of land for consideration of rupees 28 lakhs on 15/12/2022. The land was purchased in 1991, but the fair market value on 1/4/2001 is 4,36,000. Brokerage paid is 24,000. He purchased for 25 lakhs a residential flat on 30th April 2023. So, simple, what you'll do first, you'll do simply find your capital gains. You find the net sale consideration. That you can do now. 28 lakhs minus 24,000, 27,76,000. Okay. Less index cost of acquisition. So we'll take 25 lakhs into index year of sale 331, index year of purchase 8275,003. Index year of sale purchase 25 lakhs into 331. Was purchased, my bad. So this was purchased for 4,36,000. Okay, so 4,36,000 into 331 divided by 100. That comes up to 14,43,160. Okay, so your capital gains, long-term capital gains will be how much? 27,760 comes up to 13,32,840. Now, if I will have to pay tax on this entire amount, but I can claim exemption under 54F. How to claim exemption? You take now net consideration. The net claim will be how much? New asset value 25 lakhs into long-term capital gains 13 lakh 32,840. Okay. Upon old asset value, the net consideration 27,76,000. Come on. 25 into 13 lakhs 32,840 divided by 27,760 into 13 lakhs 32,840 divided 20. First you have to divide 25 lakhs divided by 27,760 into 13 lakh 32,840. So your answer will be exemption will be 12,00,032. Okay, so you will get that much. How much have you got? More. So you will remaining you will have to pay tax. One, 3, 2, 5. Remaining is taxable. Got it? Now same thing. Okay. Jessica inherited. Same things. Let's do it. Jessica inherited a vacant land and during 2001 and 2 which was purchased by her father. So if it is inherited by the father, you will still take the cost of acquisition as what is there to the father. The FMV of the vacant land was 2 lakhs. Brilliant. If it is 2 lakhs, simply take cost of acquisition 2 lakhs into index year of sale. When did the sale happen? She purchased a FMV was this much. During August, she entered into an agreement to sell the land and received in advance. This is 2022. Okay, so in 2022, she entered into an agreement to sell the land. She received in advance in September 15 lakhs and incurred registration and stamp duty. She ultimately sold the land in December and received balance consideration of 20 lakhs of which brokerage was paid. So first thing, what is the net sale consideration? During this, she entered to sell the land and received an advance. So it was for 34 lakhs. Yes, no. Okay. Balance consideration 20 lakhs and during August, she entered to sell the land, received an advance of 14. And then she also purchased land and incurred registration. So here she just sold the land, 20 lakhs plus 14, 34 lakhs, and she incurred brokerage on it. Okay, so can I say her net sale consideration is minus, okay, minus how much? 68,000. So how much it is? 33,32,000. Okay. Now, indexation you'll have to take 2 lakhs into index year of sale, index year of purchase. Come on, 2 lakhs into 331 divided by 100. So you will get your 66,2,000. Subtract. You will get long-term capital gains. What is your long-term capital gains? 2,670. Okay. Now, under 54F, you can claim exemption because she inherited land, sold it. How will you do this? What is her capital gains new asset value? The new asset value is 15 lakhs. Long-term capital gains 26,70 and old asset value 33,32,000. Okay. So what will be your final answer? 15 lakhs divided by 3332 into 26,780 1201980. That will be your exemption that you can claim. 1201980. Okay. Remaining will become fully taxable. That will be amount 1468019. Okay. This is how you will do under 54F and 54GB. Both you'll have to do this mechanism only. Got it? So we are done with capital gains. We have done all the types of sums. Nothing can come beyond this. Thank you guys.